What's up guys? I'm so excited for this because this is gonna be one of my biggest videos ever. I'm gonna be sharing my entire trading system in this video. Literally everything I know from the last 2.5 years of trading, from beginning to end, my entire strategy, no gatekeeping. Only thing I ask in return is just a like on this video if you got any value from this. But yeah, this is literally my gold mine. This is what I'm gonna use in 2025 every single day because I have so much conviction that this system works because I've seen it over and over again. There's just so many gems in here. It's crazy. Like, I wish I knew all of these things before I started trading. So without further ado, let's just get right into it. So first, a little background. I think it's important that you guys know where I got all these concepts from, how I formed my trading system. So I'm trading for a little over 2 years now, almost 2.5 years. And my two biggest mentors were Justin Werlein here on the left and then Trader Day in the middle. And those two are basically my biggest mentors. So a lot of credits to them because they helped me a lot building my trading system. So when I started trading, I started with crypto, but then I switched to Forex very quickly. And then last year I decided to make the move to futures because there's just so many benefits in trading futures. I can make a separate video on that, but that's not the point here, right? So I'm trading futures last year, end of 2023, I think. So 2 years ago, I learned about Justin Werlein. I joined his community. I watched him live trade every single day. I watched his charting sessions every single evening. And then he helped me basically a lot with simplifying ICT and SMC concepts. And also he helped me a lot with his psychology videos. I got this book recommendation from him. It's Winner Day, Change Your Thoughts, Change Your Life. And basically I'm reading this every single evening. I'm reading a verse and it just helps so much with trading psychology because you can apply this to any aspect of your life. So I would say Justin really helped me simplify ICT SMC concepts and help me with psychology. But then Trader Day last year, I joined his private mentorship and now I've been a year into this and he just helped me bring things to the next level. His quarterly theory, everything that revolves around that really helped me just dig deeper into price action and actually know like, okay, this is actually why the markets move. And so these two together with then my experience over the last 2 years, because I've been live trading every single day now, at least for a year. And that experience from me and my failures, my lessons also helped me make certain decisions in my trading system. So that's my background. Let's get right into it now. So as you can see, we start here with the word triads. So what is a triad? A triad is basically a market containing the three top most correlated assets in that market, to make it really simple. So we have 4 markets, right? You can trade. You have futures. I call this the index futures triad. Forex, the Forex triad. Bonds, the interest rates triad. And then we have the crypto market. So the 3 top pairs in each of these markets are for futures NQ, ES, and YM. That's Nasdaq, that's S&P 500, that's the Dow Jones. And then Forex, it's the dollar index, DXY, it's Euro USD, and it's GBP USD. Bonds, it's like the, not really sure about this, it's like the treasury bond futures, and then a 10-year T-note, and then the 5-year T-note. That's what you're going to use. Now, why is this important? My trading system revolves a lot around corrects. That's where we're going to go next. Types of corrects. What are corrects? Well, corrects are basically things that you can see within a triad. So I'm trading futures. My chart basically always looks like this. I have S&P on the left, Nasdaq on the middle, and then the Dow Jones on the right. When I'm trading, I'm constantly looking for cracks in correlation. And there's a lot of different types of cracks that we're going to cover in a bit. But basically a crack is a reason why I believe the markets move. It's a concept from Trader Day and it's literally insane because it works so many times. And basically this is one of the key aspects of my system. Whenever there is a crack within a triad, then I look for market to reverse. I look for a setup if other things are present, which I'm going to show later in this video. So I'm trading futures, but you can easily apply this to Forex, bonds, crypto. I would say the worst market to trade is crypto. You can do it, but very high time frame, like hour 1, hour 4, daily, weekly time frame. Bonds is just used for an indicator, like a see how that market is doing, and you can apply that to the futures market. So I really don't recommend trading bonds. Forex, of course, it's the second best market to trade, in my opinion. So you can easily apply this to the Forex market. It will work really, really great. But then the futures market is just the best, in my opinion. Cleanest price action, so many benefits. So yeah, let's get right into it. What are the different types of cracks? Well, one crack you might already know. It's SMT, right? SMT, really, really easy concept. I think everyone knows it. A bullish SMT is formed when we take out a low on an asset, but we don't do that on the other correlated asset. So let's say we take out a low on NQ, but we don't take out that low on ES. That's an SMT. Well, that's literally the base crack. This is a crack that a lot of people use that trade ICT and SMC concepts, but this is literally just the tip of the iceberg. It doesn't work often. There's a lot of fake SMTs. And so the first crack in correlation that we're going to talk about is not an SMT, but it's a sequential SMT. What a sequential SMT is basically SMT on steroids. It's basically the actual SMT that works more times than not. So sequential SMT, the name says it already. It's basically SMT between 2 quarters of a cycle. Now, if you're unaware about cycles and quarterly theory, I would really recommend, I put some arrows right here, to watch these 2 videos first. So Dave's first quarterly theory video or my simplified video I made a year ago. This basically covers the basics of quarterly theory. In this video, you will learn about cycles. So we have a lot of cycles. We have micro, 90-minute, daily, weekly, monthly, yearly, and a quadrennial cycle. We have a bunch of true opens on each cycle. The ones I use are the New York session open and the midnight open, because I'm a day trader. I scalp the New York session. And so once you understand this, I'm going to go quickly over this, that each cycle has 4 quarters, and the whole point of quarterly theory is that everything in price is basically fractal. Then we can move on to the system. So maybe just pause this video for a bit and watch these 2 videos. I link all of this flowchart in the description, so you can click on that. Also, my whole trading system I will link at the end. So no worries, everything will be there in the description. But basically, to cover it really, really quickly, we have a bunch of different cycles. And each cycle is basically a quarter within a bigger cycle, right? So let's say this is the daily cycle. We know that every cycle has 4 quarters. So the daily cycle consists of Asia session, London session, New York AM session, and New York PM session. Now this whole daily cycle containing 4 quarters is actually just 1 quarter of the overarching cycle, which is the weekly cycle. Because let's say this daily cycle is Monday, so Asia, London, New York AM, New York PM. This is basically just the Q1 of the weekly cycle. It's Monday, right? This is Tuesday, Wednesday, Thursday, and then 1 day of a week is just 1 quarter of the weekly cycle. And so if we then zoom even more out, 4 quarters of the weekly cycle, which forms 1 week, is actually just 1 quarter of the overarching monthly cycle, right? So the monthly cycle contains of 1 week, 2 weeks, 3 weeks, 4 weeks, or 4 weeks in a month. And yeah, this is basically the basics of quarterly theory. Watch this video. My video, I talk a lot about AMDX and how I then identify 1 quarter as an A, then this as the M, and then this the D or X or XAMD. I don't use that anymore. It's basically crap. I was a little noob back then when I made this video, but the basics still really apply. I would just focus on when I talk about true opens, when I talk about the cycles, that's still really, really relevant. It's the base of my system. But skip the XAMD. We know AMD runs the market, but just applying 1 quarter as A and then the other one as manipulation, it can work, but this is just the base, the tip of the iceberg. And what we're going to cover next is actually the real sauce. That's when I joined his mentorship and when he actually spilled a lot of the beans. So yeah, now that we know the basics of quarterly theory, what is sequential SMT? Well, sequential SMT is SMT between 2 quarters of a cycle. So basically you have to see it like this. Let's say we have the monthly cycle, right? This is week 1 of the month. This is the week 2, week 3, week 4. The SMT basically happens between 2 quarters. So let's say we have a low right here in the 3rd week of the month. Then we have a low right here. And we take that low out here in this quarter on one asset, but we don't take it out on another asset. I will provide images in a bit, but this is just the basics of sequential SMT. So it's basically just SMT, but the lows in terms of bullish SMT are between two quarters, or the highs in terms of bearish SMT are also between two quarters. That's basically sequential SMT. Now, there is an SMT timeframe sync, right? Because I mean, there's different types of sequential SMT. There is a monthly, weekly, daily, 90 and micro sequential SMT. And we don't just check these on the same time frame, right? We have a specific time frame to watch and validate also the specific sequential SMT. So these are the times given to us. We have monthly sequential SMT, and we spot that on the hour 4 time frame. Then we have the weekly sequential SMT. We spot that on the hour 1 time frame. The daily, we spot that on the 50-minute. The 90-minute sequential SMT, we spot that on the minute 5 time frame. And then the micro, you spot this on the 30-second time frame. This is the best SSMT time frame sync that works with this theory. Now, a lot of examples, because this is just pure theory. First off, here, this is the 90-minute cycle. So each cycle, we know, consists of 4 quarters. So the 90-minute cycle in the New York session, this is basically the best time to trade, especially between 9 and 10:30. If we have SMT between 2 quarters of a 90-minute cycle, then this is sequential SMT. Because on the other asset, we don't take out this low, whereas on this asset, we do take out. So let's say this is NQ, or this is ES, or this is YM, and this is NQ, or this is EU, GU, EU, DXY. You get the point, right? But really important here is that we do this on the 5-minute time frame if we're looking at the 90-minute cycle. Let's say this was the weekly cycle, so each quarter was a day of the week, Monday, Tuesday, Wednesday, Thursday. Then this is a weekly cycle bullish SSMT, and we check this not on the 5-minute but on the 1-hour time frame, right? Just refer to these sync time frames right here. So here I forgot to give the basic example. I jumped really fast here, but this is basically sequential SMT, right? We have a cycle, can either be micro, 90-minute, daily, weekly, monthly, yearly, quadrennial. If we have SMT between quarters of any cycle, that is sequential SMT. And so depending on what cycle you're using, you do this and check this on the specific time frame that's listed right here. Okay, so now we know this. There is also 2 types of sequential SMT actually. That's why this is actually important to check it on the specific time frame. So of course we have a bullish sequential SMT and a bearish sequential SMT, but the normal one just looks at the highest high of the previous quarter or the lowest low of the previous quarter. So a bullish sequential SMT, what is this? We take out the low of the previous quarter while we create a failure swing on the other asset. So failure swing means that we don't take out the low, we just fail to take out the low. Now a bearish sequential SMT is we take out the high of the previous quarter while we create a failure swing on the other asset. So really important here, sequential SMT, we take out the low. So the low of the previous quarter, not any low. When I first started out using this, it was tricky, but you need to use the lowest low of the previous quarter or the highest high of the previous quarter in regards to bearish SMT. Now examples. Let's say you see here 1-hour time frame. What does that mean? I'm looking at the weekly cycle to spot weekly sequential SMT. All right, so right here, weekly cycle consists of 4 quarters, Monday, Tuesday, Wednesday, and Thursday. If we see that we take out the previous quarter's high on one asset, but we don't do that on the other asset, that's a weekly cycle sequential SMT, a bearish one. Because here you can see that on NQ, we take out Q2 of the weekly cycle, which is Tuesday's high. Sorry, we don't take this out on NQ, but we do take this out on ES. So this is a weekly cycle bearish sequential SMT. What you do, very simple, whenever you're looking for sequential SMT, you look at the previous quarter. So now it's, for example, Wednesday when I look at the weekly cycle, I always check Tuesday, that's the previous quarter of that cycle. I check the highest high or the lowest low. We see here that we take out the highest high on ES, we don't do that on NQ. But it can also happen on the lows, right? This is the lowest low of Tuesday, and this is the lowest low of Tuesday as well. We both take this out, right? So there's nothing to see here, only at the highs. So another example, let's say we use the 50-minute time frame. That means that we are gonna try and spot for a daily sequential SMT. And what do we see right here? Daily cycle basically consists of the 4 sessions of the day. As I said, Asia, London, New York AM, and New York PM. In this case, I'm mainly trading New York session, so I will always refer to the London session to look for sequential SMT. And if you guys already start to realize, like, this is why a lot of people use like previous sessions high taken out, previous sessions low, previous day low. This is why this works. This quantity theory, this is why it actually works. If we have sequential SMT there, that's why price moves. So here, for example, the London high, London is from 0 to 6 a.m. EST, then New York is from 6 to 12. This previous quarter, this is the highest high of London. We don't take this out on ES, but we do take that out on NQ during the New York session. So that is an example of a bearish daily sequential SMT. Okay, but why is this also so important? Why is it so important to check the monthly specifically on the hour 4, and why can't you do this on the 1 hour? You can spot this, you can spot the monthly sequential SMT on the 1 hour if you're just looking for this type of SMT, just a normal sequential SMT. But this is why it's actually important, because we have also something like a hidden bullish sequential SMT or a hidden bearish sequential SMT. Now what this is, it's basically, like it already says, it's hidden. You don't really see it. Like, we both take out the low on both assets, but it's still sequential SMT. Now, how can this be? Well, a hidden bullish SMT looks at the closes. You know, a lot of people say that the wicks do the damage and the body tells the narrative. Well, that's also where this comes from, and that's why also that works. Because hidden bullish sequential SMT, we basically look at a candle in the current quarter closing below the lowest close of the previous quarter, whereas we do not do that on the other asset. A hidden bearish sequential SMT is that we close a candle above the highest close of the previous quarter, whereas we do not do that on the other asset. And that's why it's really important to refer to a specific time frame when looking at a specific cycle. So, examples of hidden bullish and hidden bearish SMT. I think these are bullish examples, yeah. So, 50-minute time frame. Okay, you gotta think 50-minute time frame, that is using the daily cycle, right? So, you would say here, I think this is London, this is New York. You would say that this is not a daily sequential SMT because we both take out the lowest low of London. Well, but this is actually a hidden bullish sequential SMT, because how this hidden sequential SMT works is, like I said, we look at the closes, the lowest close, not the lowest low, or the highest close, not the highest high. So here, the lowest close of this session, this quarter of the daily cycle, is here. And you see we close a candle below this, okay? But we don't do this on NQ. You see, this is the lowest close. This is where the quarter just started. So here, this close is part of this quarter. You see, we do not close a candle in this quarter below the lowest close of the previous quarter, which is this quarter. So this is a hidden bullish daily sequential SMT, and why price moved up from here. Another example, this is the 5-minute time frame. So you know, okay, we check what on the 5-minute time frame? We check the 90-minute cycle on the 5-minute time frame. So 90-minute cycle, 90 minutes is 1 quarter. For 90 minutes is basically 1 part of the daily cycle. I can go on and on, but I think you guys get it. So here you would also say that we just both take out the low of the previous 90-minute quarter. But actually, if you look at the lowest close, this is lowest close, we do not close a candle below the lowest close of this quarter on ES. But we do that really obviously on NQ, right? So this is a bullish, sequential, hidden SMT. And this is why it's really important to have a specific time frame correspond with a cycle, because you can't just check the hidden sequential SMT on the 1 minute time frame if you're looking at the 90-minute sequential SMT, right? It has to be on the 5 minute. That's why it's really important. This is basically the theory and the time frame that syncs with the cycle. So knowing this, literally, this is, you can already form a model around this. This is already super, super crazy. Sequential SMT is basically the base of my system. This is the biggest cracks of all of them, right? We have a bunch of different cracks, but this first one, sequential SMT, is the biggest one. Whenever I see this, I already look for entering a trade. I already look, of course, there's a lot of other things. This is basically the base, right? So understanding all of this, you see this is the biggest explanation. The other ones are a little bit simpler, but understanding this, understanding that there is SMT, which you can use. I still use SMT, but the better one is actually sequential SMT. If you know that this is SMT between two quarters, you have a sync, you have two types of SMT. You have a normal, where we look at the highest high or the lowest low of the previous quarter, and we check if that got taken out on the current quarter or not. Or we have a hidden sequential SMT, which I just explained, right? So a lot of examples here. I think just go over this once again, because this is literally super important. This is the base of my system. Now, another type of crack, which I would class as the second strongest one, or even as important as sequential SMT actually, is a precision swing point, a PSP. Now, what is a precision swing point? A precision swing point is basically a swing low or high, which is an up close candle on one asset, but a down close candle on another asset. Now, swing low and swing high. Let's first start with this first saying. What is a swing low, a swing high? Really easy. Let me just point it out on the chart. A swing low is, for example, this here. Swing high. Oh my God, sorry. This is a swing high, of course. A swing low is here. Why? Why is this a swing low and why is this not a swing low? Well, a swing low is where the low is basically lower than the low of the candle previously and the low of the candle next to it. So it's a 3 candle pattern, basically. This is not a swing low because the candle to the right sweeps that low, right? So that's basically, in theory, what a swing low and a swing high is. This is a swing high because this is the highest point. This right and left candle don't take out this high. This is, for example, not a swing high. Why? Because this right candle takes it out, right? So really, really easy, but this is really needed for this to understand precision swing points. So it has to be a swing low or swing high, which is an up close candle on one asset, but a down close candle on the other asset. So let me give you an example. This is an example of a 50-minute PSP. Now, why do I call it a 50-minute PSP? Really simple. It's because I'm looking on the 50-minute time frame, right? Makes sense. Why is this a PSP? Well, first of all, is it a swing low? Yes, because this candle right here has the lowest low. This right and left candle, they all have price moving above this lowest low here also. So this is a swing low. Now, why is this a precision swing point? Well, if you look closely, what is the difference between these candles? If you see it, we actually have a down close candle on NQ, but the same candle on ES is actually up close. So this is what a PSP is. It's a really easy concept. It's a swing low or a swing high where the same candle is an up close candle, but then on the other correlated asset, it's a down close candle. So you don't really need the Dow. If you see a PSP between ES and NQ, it's already enough. But let's say these are both down close. Also on ES it's down close. Then you see on YM that is up close, so you can use that. But it's enough to use ES and NQ for this. So that's the basics of a precision swing point. So with this sequential SMT and a precision swing point, you form basically a setup with all of the other context and confluences I'm going to give you later in this video. Now we go to the less important but really good if you want to master entries and just go to the next level. So you don't really need these, but it's really, really good to know them because they can help you a lot with bias and with entries and to just bring things to the next level. So a precision candle, it's really easy. It's basically, let's say you copy paste precision swing point to here. It's the same thing unless it doesn't have to be a swing low or a swing high. So a precision candle, PC, is an up close candle on one asset, which is a down close candle on another asset. It's the same as PSP, like I said, but it doesn't have to be a swing low or swing high. Now, I don't really know why I don't have an example with this. Oh yeah, it's because it makes sense, right? Let's say this candle right here, it's an up close candle on NQ, but it's a down close candle on ES. It's not the case here, but let's say this is a down close candle, then this would be a PC, a precision candle, right? So it's the same concept, just it's not a swing low or a swing high. Then a precision gap, what is this? So you see the pattern right here already, right? It's basically things that are happening on one asset of the triad, but not on the other one. It's SMT, but then taken way further. We basically look for cracks in correlation because if you think about it, these markets, they should just all, they should correlate with each other. So NQ, if it goes up, ES needs to go up. If YM goes up, NQ should go up. If that doesn't happen, that's a sign. That's a sign that the market is ready to do something when they are out of sync, right? So precision gap, now going to the next crack in correlation, is a PSP. So again, same concepts. It's a PSP, but it's also a gap, but not on a gap on the other asset. So this can be used for entries basically, or just for bias if this is on the higher time frame. So an example of a PG, a precision gap, can be this. So first of all, precision gap is a PSP. So same thing. Why is this a PSP? It's a swing low. It's the lowest low in the candle next or right to it. It doesn't take out this low. So it's a swing low. Check. It's a PSP because it's an up close candle on NQ, but it's a down close candle on ES. So okay, PSP. But it's a precision gap also because it forms a gap on NQ and it doesn't form a gap on ES. So that's why you can see price really cleanly tapped this and moved up because this is a really nice entry model. You don't need this, but it's really, really nice to level up your knowledge about cracks in correlation because this is also a crack, right? This should be also an up close candle and forming a fair value gap on ES, but it is not doing that. So that's the crack in correlation. That should not happen. So it means that this is where the market can reverse from, right? Okay. Then last two, SMT fill. What is this? Well, SMT fill is basically a gap fill, so fair value gap fill on one asset, whereas there's no gap fill on the same gap on another asset. So how does this look like? An SMT fill, also really easy to spot. And when you see it, it's just so powerful because this worked more times than not every single day in the market. So how does this work? Well, SMT fill, we take the same gap on both correlated assets. This is a 1 minute gap. The same gap is found here on ES and Q. We mark out the gap and we see that we actually fill the gap on NQ. Sorry, this is ES. We fill the gap on ES and we don't do this on NQ. That's an SMT fill. When you see this happening and you see this not happening, you don't need to see this gap getting filled because it already happened on ES. You kind of see it as all these assets in one market. So if you're trading futures market, you have NQ, ES, and YM. If one asset already did something, then the other asset doesn't need to do something, if that makes sense. Also, it applies to everything that I'm going to talk about later. Just every concept, if one asset already did something, that means that, okay, we are ready to go. Like you don't need to do this on ES or NQ if it happens on the Dow. So that's why SMT works. We take out the high, so we don't need to take out the high on the other asset. That's SMT, basic SMT, right? So yeah. And the last cracking correlation is actually an SMT market structure shift. What is this? You can already say a cracking correlation is something that happens on one correlated asset but does not happen on the other asset. So you can already tell what this is. It's basically a market structure shift on one asset, but not on the other one. So an example of this is we are in a bullish order flow. We are in a bullish market. We go up, we take out the high. Now this can be like, you can see this as a market structure shift. You can see this. It doesn't really matter. It basically has to be like a shift in market structure. So we take out the high, but we do not do this on the other asset. Now you would say, well, this is just an SMT, right? Well, yeah, but if the SMT is bigger on the bullish side, the context is way bigger on the bullish side, then just one small SMT on the other side, on the lower cycle, is actually seen as an SMT market structure shift. It's just there to validate a market structure shift and to maybe retrace price a little bit before then continuing the trend, if that makes sense. So don't worry too much about this. It's a lot of information. This is information that I've learned over like 2 years. So I would recommend watching this video at least like 10 times because this is so much information, and I'm sure it wouldn't make sense after watching it 1 time because it didn't make sense to me in the beginning. So I think I added some notes here. So this can be an SMT or sequential SMT, doesn't matter. It's just a way to identify real market structure shifts. Example, if the biggest cracks, like I said, or context point bullish, we're really in a bullish market, so many things point up, and you see just one small cycle, like a micro or a 90-minute bearish sequential SMT, when we take out the next high, just deem that as a real market structure shift. Of course, if you're in a trade, partial out or take profits, expect a retracement. But do not see this as something dangerous for the trend or the vision that you have, because it is just there to validate the market structure shift. So knowing this is already the base. This is literally almost everything. The next thing is just bring things to the next level, because you can trade basically based on this. The way you form a system right now with only this information is basically you just look for sequential SMT, you look for position swing point, and you pair that. You at least need 2 cracks in correlation to form a setup. Now, these are mainly for entries and for bias. So mainly you look actually for a sequential SMT and a precision swing point, which I'm going to talk about here. If you see these 2, like we have a sequential SMT, and that low making sequential SMT, or that high making a sequential SMT, is a precision swing point, then that can be a setup, right? So talking more about this, what you need to do now is you need to monitor for inter-triad cracks. So inter-triad just means that you look for cracks between these assets. Now, there's something else, which is, I'm not going to talk much about this, but you can check for cracks between these assets of the futures market. But taking things to the next level is if you check the cracks between this market and this market. So you basically check if NQ took out the high, but then EU not. So this is, don't worry too much about this, but this is actually also a thing, because if you know, if the futures market goes up, Forex should also go up, the bonds should also go up, crypto should also go up, except the DXY should then go down. So if you see cracking correlation between markets, that's called an inter-market sequential SMT, or inter-market precision swing point, or an inter-market market shift, right? You can all have all these things. It's really, it goes really far, what I'm saying. But for now, I also just mainly use this, something that you should not really focus on right now. You can do everything actually with this. So I got too much into this, was not my intention, because I was going to talk about this later actually. But I think it's important to know what inter-triad means and then what inter-market means. So inter-triad is within a market, so within the futures market, and then inter-market is between markets. So inter-triad tracks, let's say you're trading Forex, you will always have a chart like this. DXY, EU, and then the British pound. If you're trading futures, then you will use this triad, ES and QYM. I trade futures, so what I do is I monitor for inter-triad cracks. So what are these? We just talked about them. SMT, PSP, precision candle, precision gap, SMT fills, SMT market structure shift. Did I forget something? 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5. No, These are all the cracks, and you basically need to monitor between them. So basically what I do every single day is I check, okay, I go from the highest cycle to the lowest cycle. So if I'm starting, I start on the 4-hour time frame for the monthly cycle. I make sure I have this indicator on, day quarterly theory. I check on all these cycles. And I basically look for these cracks. So 4-hour. Do we have a 4-hour precision swing point? Do we have a 4-hour sequential SMT? No. Do we have a 1-hour on the weekly cycle? Do we have a daily sequential SMT? You check this on the 50-minute. Do we have a 90-minute sequential SMT? Sorry, we do this on the 5-minute. Do we have a micro sequential SMT? I check and validate this on the 1-minute time frame. Sorry, on the 30-second, right? So yeah, that's basically how it works. I monitor for inter-triad cracks, and mainly for these two. These are just for entries and for bias. So for example, if I see on the 4-hour time frame, we fill this gap, but we don't do that on another asset, that can be used for bias, for example, okay? So we monitor for these cracks on the monthly, weekly, daily, 90 and micro cycle. Now you can go and take this further to the quadrennial cycle, but that's really, I'm just a day trader and I don't need to go so far back. It can be for precision, but I don't personally use it. So focus on trading in the direction of the biggest confirmed cracks. Now, what is a confirmed crack? If we have a sequential SMT, it doesn't mean that it's already confirmed, right? If we just take out a low on the previous quarter and we don't do that on the other asset on the current quarter, then it's a sequential SMT, yes, it's a potential one, but it's not really confirmed. So we will go to confirmation later on, but just know that it's not that because we do this, we have a sequential SMT, you see it, that's actually already confirmed, right? So what do you need? You need at least these combinations of cracks to form a setup. First of all, let's say you see a higher time frame sequential SMT or a high time frame SMT, and you see a lower time frame sequential SMT. That is already something that you can use to form a setup. This is basically the best thing that you can see. A higher time frame SMT followed by a lower time frame sequential SMT. How does this look like? Example. It's like a puzzle. This is how it ideally should look like. This is just drawn with the tool on TradingView, right? It will not always look like clean like this, but this is the theory, right? We have a higher time frame sequential SMT. So let's say it's really, really hard to see, but this is 2 quarters of a higher time frame cycle. This is 2 quarters of a lower time frame cycle. So let's say this is the weekly cycle, and then inside the 1 weekly cycle's quarter, let's say Monday, this is like a quarter of the daily cycle, right? So the best thing is that these cycles basically follow each other. So it's the one immediately below it. So if this is the weekly, you should check for a lower time frame SMT on the daily. If this is a 90-minute higher time frame SMT, and then this should be a micro sequential SMT on the lower time frame. So higher time frame doesn't mean hour 4 daily, just higher time frame than this one, if that makes sense, right? So this is basically a SMT, sequential SMT, plus lower time sequential SMT. You should see something like this. We spot the sequential SMT on this cycle, and on the cycle below that, ideally you should see then a lower time frame sequential SMT. Now this doesn't have to be that then the first one has to be a failure swing and the lower time frame has to be a turtle soup. It can be failure swing, turtle soup, but I tend to see that these work better when we have the higher time frame one forming a failure swing and the lower time frame one forming a turtle soup, but it can be the other way around, doesn't really matter. I think this just works the best. So that is, this can be like an SMT as well, but it's better if this is a sequential SMT. The lower time frame should always be sequential SMT, but the higher time frame can be an SMT, but it's preferred to be a sequential SMT. Man, it's gonna be a lot. We've just started. So sequential SMT plus precision swing point is a second type of setup that you can have. So how does this work? Following this line here for an example. If we have a sequential SMT, so if 1 quarter here, 1 quarter here, 1 quarter here, 1 quarter here, we have an SMT, but it's a sequential SMT because it happens between 2 quarters. And that low making the sequential SMT is a precision swing point. Okay, So this is a setup. And to know which PSP works the best for a specific sequential SMT, you basically have to go back to this here, the sync, the SMT timeframe sync. This is what you use to spot the SMT. You spot a weekly SMT on the 1 hour time frame. So then you also need a 1 hour PSP if you're looking for an SSMT plus PSP setup, right? So let's say, where are we here? This is a daily cycle that we're looking at. And the daily cycle, you look for SSMT on the 50-minute time frame. So this is a 50-minute sequential SMT, a daily cycle sequential SMT. Then you should also look for a 50-minute precision swing point. I mean, this can also be a 5-minute, a 1 hour precision swing point, but it's just the best. This is like the sync. This is the sequence. This is how it should work, how it should function. So that's that. And then SMT in a gap is also a really nice setup, but not the best one as high time frame SMT plus lower time frame SMT. SMT in a gap, SSMT in a gap, sorry, is basically what it already says, really simple. We have a gap. This can either be a fair value gap, a new week opening gap, a new week opening gap, what else, like a volume imbalance, whatever, a gap, right? And we have an SMT, a sequential SMT, because it happens between 2 quarters. And it happens in a gap. That's it. I think I was going to give more explanation, but it's actually really simple. And the last one, we have a higher time frame SMT or sequential SMT, plus a turtle soup of lower time frame SSMT. So this is a little bit more advanced, but I really like to play this one lately. It is not the best if you're just starting out with this, because it's really hard to spot and validate which ones are valid. You have to have a lot of context also, which we're going to talk about later. But this can be really, really nice for precise entry. So an example of a higher time frame sequential SMT plus turtle soup of low time frame SSMT is this. So we have a higher time frame SMT. Okay, so this is already a bias for me. We have a sequential SMT on the lows. Okay, I'm leaning bullish, right? Unless we don't have an higher time frame bearish one, which is bigger or equal of the size. So then after this higher time frame, we have a lower time frame sequential SMT. And then we have a turtle soup of the low of that lower time frame sequential SMT. So you would say, like, you can enter already here, right? This follows this setup already. Higher time frame plus low time frame. Higher time frame plus low time frame. Well, if you took this, you would most probably see that we already took out the next high, so we would already taken profit right here. Now, if you see, for example, that we take out the lower time frames sequential SMT with a clean turtle soup, like, it's really easy to spot a turtle soup. Like, you just need to see that it's a big wick and it doesn't really want to go lower. It's not displacement. It really looks like a sweep, right? So if you see this, this can also be a setup. You enter then after the turtle soup and target the highs and even further draw on liquidity. But this is basically how it works. And I'm going to give one example later also on the charts. It's not that I'm just going to give theory. So these are the 4 types of combinations that I use, that you can use. Now, a key level makes the setup higher probable. Now, example of a key level is already like a gap, like it's a key level, it's a fair value gap, but a key level can also be a high or a low. If this all happens above a higher time frame high or low, if this happens inside a new week opening gap, if this happens inside a higher time frame order block. I don't really like to use order blocks, but you can use them for higher probability if this all happens in an order block. Let's say we have an SMT plus PSP like this, and this is happening inside an order block or something. Like, key levels make everything higher probable, of course. It's just basically a key level is a higher time frame PD array. So yeah. So we have one of these things, okay, but this is not everything. You can just take a trade using this. I mean, you can form a model, but I want to be more precise. I want to really be on the right side. I don't want to take any errors, if that makes sense. So I need a lot more context that we actually are bullish on the high time frame, that we have everything aligned and price is ready to move. So how do we check that? Well, I need more context. I would say this is mainly, this is basically just quarterly theory, and this is basically my own experience and a little bit of Justin Werlein as well. So cracks is the base of any setup. You look for these things, but without any context, like, they are irrelevant. They are irrelevant without proper context. So we need context to pair it with a specific type of combination of cracking correlation. So we have 4 types of context that I use. First of all, I'm checking if I'm still recording. We are already almost an hour in. I don't know how long this will still take, but I'm gonna go on, splitting everything. So the first context, one of the biggest I use, together with drawn liquidity, is the 4 reasons why markets move. This just makes so much sense. Like, it's something that you just can't neglect. It's always there. You always see price hunting liquidity. You always see price rebalancing to equilibrium of the range. You always see price rebalancing to inefficiencies. You always see price generating liquidity. These 4 things you just can't neglect. Like, whenever there is something, like, there's always a rebalance to a gap. We always hunt for liquidity. We always generate liquidity to then later on manipulate into it and then go to drawn liquidity. It always happens. And at least one of these reasons should be a confluence for my trade. So let's say we have this crack. We have an SMT plus PSP, right? Or yeah, let me just, yeah. Where is this? SMT plus PSP. Let's say we have this, like, to apply this context to it, this can, for example, be in a discounted gap. This can be after retracement, after rebalance. We have a lot of engineered liquidity right here. There is a lot of liquidity here that we took out. Like, at least one of these things should be present, right? It's really easy. It always happens. So you always have one of these things, but it just helps a lot with bias. So at least one of these reasons should be confluence for a trade. So whenever we have a higher time frame sequential SMT plus a lower time frame sequential SMT, nice. But does this has one of these reasons? Like, is this happening after rebalance to equilibrium? If that is the case, then it's higher probable. This is taking that context with it, because you will most likely see these things happening after we rebalance to equilibrium, after we rebalance to inefficiency, after we generated and took out liquidity. This is where the SMT comes in. And then after we have like a nice liquidity to target, right? So different types of liquidity, gonna go deeper into that later, but this low resistance liquidity, it's basically trend line liquidity, equal highs, equal lows. A PSP and a precision candle can also hold a lot of liquidity. That's actually a gem also. And yeah, that's basically it. Okay, so we have the first type of context discussed. 4 reasons why markets move. It just makes so much sense. It's something that Justin Verlaine really hammers on. It's a really nice thing to have as a confluence to validate your bias, etc. So then, second thing, if not the most important thing, is a drawn liquidity, right? This is actually taken from this also, but goes a little bit deeper. So the drawn liquidity. With every setup, you need a confident higher time frame drawn liquidity, and you need a confident lower time frame drawn liquidity. This is where market maker models come in, right? I always trade a lower time frame market maker model. Now the higher time frame can also be a market maker model, but I'm a scalper, right? I trade market maker models on the 1 minute, 5 minute time frame. So we need a confident higher time frame draw and a lower time frame draw. Then next, this is also one of the most, actually everything is important, never mind. So true opens, what is this? SMR, smart money reversal, is below the true session open and a true day open for longs. The SMR is above true session open plus true day open for shorts on at least one asset. Now, what does this all mean? Don't really have an example, I think, but we're gonna discuss this later on the chart. Basically, how this works is we have price-based discount and we have time-based discount. Why? Well, this concept right here, true opens, I would class this as a time-based discount. So price-based is what everyone knows. It's the easiest type of discount that everyone knows. Everyone does things like this, right? Low, high. This is discount, or the other way around. But this is actually the easiest thing. This is nice to use. This is what we use for this. Why markets move, they rebalance to equilibrium, okay. And then most likely we look for a gap in premium to then long if we're in the bullish market, but we're in a bearish market, so we look for, premium levels. So we then look for gaps right here. That's basically how everyone trades, right? But there's also something like time-based discount and premium. And that's where we use true opens, right? So I'm a scalper, so I mainly use the session true open and the day true open. If we are bearish, then I look for price to tap and form the smart money reversal of the market maker sell model above the true session open and the true day open. If I'm long biased, then I'm looking for that smart money reversal to happen below the true session open and the true day open. That's a confluence also. Context is basically confluence. So on at least one asset also. So let's say we take this for example. Always every single day what I do is I go on the 5-minute time frame, I spot the true session open, but we have like true week open, true month open, right? All of these cycles, they have them open, but I just use the true session open and the true day open, which is 7:30 for the New York session and midnight o'clock EST, it's all EST time for the true day open. So going on the charts, for example, today, what I do every single day actually is 7:30. That's true session open for the New York session. Okay, true session open. And then I look for midnight today. It's right here. Like this, true day open. So literally it happens every single day. The smart money reversal here for NFP, just literally today's price action. We did this, we swept the high above true day open and true session open. So this can be another context. Okay, I'm bearish, we sweep above the true session open, true day open, and we respect that. We form a smart money reversal right here. That can be confluence for a trade, right? So it doesn't have to be above true day open. Above true session open is enough for me. There's some times where we have a really, really bullish market and the true day open is all the way out here, but we are trading right here and we have a true session open right here, then a true session open is enough. It's not as high probability, but it also can work if you just use a true session open. And also, there's a sequence, like if we're looking for shorts, then the true session, man, I'm talking too fast, sorry. If we're looking at shorts, then we need to have a true session open above. If we're looking at longs, then we need to have the true session open below. But that's just, I don't really use it anymore. You can, that's if you only want to play like the high probability setups, but it doesn't happen every day. I like to trade everything that makes sense, and if there's a setup, there's a setup, if that makes sense. If you get what I mean. So, and also, like, let's say this is NQ, we do the smart money reversal above, that we don't need to have ES or YM tapping above true day open, true session open like this. Like this is what I said earlier, remember? If one asset does something, the other one does not have to do that. So that's why I wrote down right here on at least one asset of the triad, right? So, okay, true opens. Also maybe to know true session open, this remains valid until the session ends, of course. So that's 12 o'clock right here, and then the true day open ends when the day ends, right? That's 6 p.m. The day ends at, yeah, right here. Okay, so knowing this, let's get back. We have the true opens, we have this, we have this. Last one, also really important, is time and price. Time in relation to the market maker model. Is the structure looking ready to make a move? Does price action look clean, basically? That's what this means on the first line. If we don't have a clean market maker sell model, market maker buy model, it doesn't have to look like this. It will never, ever look like this. It will always be something off, but it just needs to look clean. Do we have engineered liquidity? I really recommend watching Justin's video on this. That's where I learned a lot from. But we have engineered liquidity. We have a clean move down in some gap. We have a clean manipulation. We have a clean market structure shift. We have clean generated liquidity. And this happens at the right time, at New York Open or at the macro, right? So this is what I mean with, does the structure look clean? But also, is this happening in a 90-minute quarter of a red folder news event? This is not really needed. But like, for example, now we have NFP. We just dropped like crazy. If we have a setup right here, SMT plus PSP, there is context. We have the drawn liquidity. We have a market maker sell model low here. Okay, nice setup. But does this happen at a key time of day? Yes, it's literally at news. It's at 8:30 NFP, right? I have a nice indicator right here. Live economic calendar. from 2 degrees, you show here the news, right? It's red. This was unemployment rate and NFP. So a lot of people, they say don't trade news. I really disagree with this. News is needed for good setups. I'm not saying you should enter right on news, but there should be news, a red folder news event around when you're looking at a setup. So that's why I'm saying your setup needs to form within 90 minutes of that news event happening, or maybe an hour, 2 hours, but makes sense, right? That's why Monday is low probability to trade if there's no news. If there's no news, it's also just low probability in general. You should not enter right on news. It can be. There's some times where news will just expand and not manipulate, and that goes a little bit deeper, but let's say price manipulates. That means that there was no sequential SMT present yet on the lower time frame. If we just expand, that means that we actually already have a setup here at the highs. We have a sequential SMT, we have a PSP, we have context, we have drawn liquidity, we have true opens, confluence. If we have that, then news will most likely just expand. Like it will just follow whatever the algorithm pinpoints already to you. I don't care what it is, FOMC, NFP. I just know that if there's a setup present and we have news, it will expand to the drawn liquidity. If we don't have a setup already, I don't have any cracks, then I expect news to manipulate and create cracks, create an SMT, create an PSP, create an SMT fill, if that makes sense. So news is really important to trade. You should trade on news days. News days are good to trade. So where are we? So time and price, what do you need? It should look clean. The market maker structure should look clean. So time in relation to the model. And it should be in either 90 minutes of a red folder news event, or around the New York Open. That's when we have a lot of volatility, or in a macro window. This is where hourly candles close. So macro windows, best ones. I use 30-minute windows. So the best macro windows, in my opinion, 9:45, 10:15, 10:45, 11:15, 11:45, 12:15. I would say best ones are actually just 9:45, 10:15, and then 10:45 to 11:15. So yeah, we should have one of these things for a time context confluence. So it should be at least one of these 3 clock times as a confluence, and the market maker sell model or market maker buy model needs to look clean. So that's basically it. You form a setup. If we have context ready, everything makes sense. We have draw, we have true open, we have the draw, we have a true open confluence, we have the 4 reasons why markets move confluence, we have a true open context, we have a draw context, we have a 4 reasons why markets move context, we have a time and price context. We pair this with one of these setups. We monitor basically for all of these cracks, and you only trade in direction of the biggest confirmed cracks. So let's say we have a daily sequential SMT here. So you will see I point this out like this, right? SMT 90, daily, micro, monthly, weekly. Let's say we have a 90 here. Let's say we have a 90 here. If we have, along with this 90, a daily higher time frame, then I'm looking for shorts. Even without this, because the bearish side on the cracks is more important. Let's say we also have a PSP right here. Still really nice. Let's say we have it like this, then I'm looking for longs now. But if we have a daily which pushes us down to drawn liquidity, and then we have a daily opposing, then I can delete this one, right? So it's whichever one comes first, and whichever crack and is the biggest, whichever makes more sense. So you basically monitor 2 sides of the market. You check for the highs and for the lows. If we have better PSPs, sequential SMTs on the lows, we look for long bias, right? With all of that other context, right? So that's why you focus on trading in the direction of the biggest confirmed cracks, and you need to pair this with context. So you monitor for cracks and context and trade in the direction of the biggest confirmed cracks and context. That's what I mean. Now when to enter. This is going to be a lot more easier. We covered basically everything already. So let's go. This is the sauce already. This is just from my experience, from my mentors. This is what I personally like to use best for entry criteria. So when to enter. Confirmation. Displacement. I need to see like an inverse fair value gap. I really like to use inverses on the SMT plus time frame sync time frame of the lower time frame sequential SMT. So this means, let's say I'm trading mostly I'm trading these. So I have a low time frame sequential SMT. So mostly I'm trading a higher time frame SMT plus a lower time frame sequential SMT. So this looks like this, right? Remember, what is a displacement? Let's say this lower time frame SMT is on the daily time frame. Then I look at the sync of the SMT time frame sync. If it's daily cycle sequential SMT, I look for a 50-minute displacement. Makes sense, right? So that's the SMT time frame sync displacement that I need. So displacement can be enough, but an inverse fair value gap is what I found works best. And if we don't have that, we don't form a fair value gap, or we don't inverse another opposing fair value gap, then it's just lower probability. So I really like to see price inversing an opposing fair value gap while having a displacement on the time frame of the lower time frame sequential SMT. So I'm a scalper, so mostly the lower time frame will always be like a micro sequential SMT. So mostly the setups that I trade will look like 90 minutes sequential SMT is the higher time frame one, and the micro sequential SMT is the lower time frame one. And so to have a confirmation, I need to look for the SMT time frame sync of the lower time frame sequential SMT. So in this case, I'm having a micro bullish sequential SMT. So if you look right here, that means I should have a displacement creating an inverse value gap on the 30-second time frame. So that's the main confirmation criteria I use. But there can also be times where if you try to wait for displacement, it's already too late and we already create a clean turtle soup, right? If it's a really clean turtle soup, you know this, you see this. I'm going to show examples on the chart. There's times when we have like news manipulating at the lows and we don't take out the low on ES, but we do take out really cleanly, souping a low on NQ. We displace right up after that. If you're talking about the bullish turtle soup, it just looks super, super clean. We have the higher time from order flow really just respecting every bullish PDRA. That's what I mean with a clean turtle soup, and I'm going to show examples on the chart later. But I basically use the higher time frame order flow to spot the clean turtle soup. So usually, for example, what I mean with this is we have like I mainly look at the 5-minute and the 50-minute time frame, or maybe sometimes the hour one time frame to see like, oh, this is like a clear AMD of the candle, right? We have the 50-minute candle starting manipulating the lows, and then we have the body closing the candle really much above the sweep, right? So that's what I mean with a clean turtle soup, if you get what I mean. I hope so. So then the entry, there's a lot of things that you can use. I don't like having one specific type. Like everything makes sense. If the setup looks clean, if you have everything you need, there's multiple ways to enter, right? So best thing that I like to do is just market enter. When everything looks clean, I just enter a market buy or sell. So that's after then the displacement with creating an inverse value gap on this time frame, or a turtle soup. When I see this, market enter. There's times where I just wait a little bit and then I just enter on a fair value gap. No need to have an explanation, right? You just see a discounted or premium fair value gap if you're looking at shorts, and you place a limit there. But I really don't like to place limits. What I like better is just waiting then after a first entry reaction. So let's say we then tap the fair value gap or tap an order block, and then we have a reaction from that, then that's where I also then market enter. So I'm either market entering, setting a limit, but nowadays I really like to wait for like a reaction of a PDRA, then I market enter as well. Or this is a little bit harder. This is later after the smart money reversal, but after more cracks and context with confirmation if the low hanging fruit is still intact, if we don't already take out the clean liquidity, and that's usually then the liquidity of the market maker sell model, like the original consolidation. So this is when you didn't catch the top or the bottom, but we're just still inside the range. We displaced inside the range. We're really close to the drawn liquidity. So then you can wait for a re-entry after a retracement, and then after you see more cracks and context. So you see another high time frame SMT plus lower time frame SMT sequence, or you see something like this. Then this is usually when this happens. Like we have the smart money reversal. This is the high that we target,
and we just have like something like this where we sweep the lower time frame sequential SMT, or we have just something like this in a gap also. But the point is that if you miss the top or the bottom, there's always more entries. Like after we have some consolidation, then we have another sweep, we form some cracks, some more context, we do that below it through the open. You get what I mean, right? But the drawn liquidity just needs to be intact. If the drawn liquidity is taken out, like just stop looking at entries, because that's the main objective of the day. If the main objective of the day is taken out, the liquidity is taken out, then you should not look for any more entries. So that's basically everything regarding confirmations. But if you want to take things to the next level, you can use, like I said, these cracks, right? A precision gap, an SMT fill, or an SMT market structure shift. So you can use them as a higher time frame bias, like an hour 4 SMT fill, where we on NQ we tap an hour 4 fair value gap, but we do not do that on ES. Can be used, but it's actually even better to use to have even more precise entries. All right, so let's say we have all of these setups. Okay, we have a displacement, and then we also have an SMT fill, or we also have a precision gap, or we also have an SMT market structure shift, right? That can be used for also confluence, right? You then take an entry on the precision gap, you take an entry after we react from the SMT fill. This then means this, after first entry reaction, this would be like after we have an SMT fill, and then we do this, if that makes sense, and then precision gap, we have a limit on the precision gap like this, and then SMT market structure shift. If you see that, you can just wait after more cracks and context with confirmation if low and is still intact, or you can just market enter. Okay, so this is open to a lot of interpretation. You can do whatever you want with this. This is just how I use it. Then stop loss should be at the high or low of the lower time frame sequential SMT, PSP, precision candle, precision gap, SMT fill first entry. So if you're trading this setup, high time frame sequential SMT plus lower time frame sequential SMT, stop loss here, I think it all makes sense, right? Here also you do the stop loss at the low, PSP low. I mean, this makes sense, right? Here what you would do if you, this is like a turtle soup confirmation. So you would then enter right after you see clean reaction of this turtle soup, and then stop loss at the turtle soup low, of course, or a little lower. This is open to you, but this is what I use. So stop loss should be at the high or low of the lower time frame SMT, basically the high or low of the cracks where you formed your setup from. Usually when I get stopped out is because I just put my stop loss at a random, for example, like I put my stop loss at a random high that doesn't make sense, that doesn't have any SMT, right? If this is SMT, like this, then my stop loss should be right here, right? So yeah. Now after first entry, this is not ideal. You can get stopped out with this, but this is just to increase your risk to reward. For example, we have SMT right here, right? I'm just gonna give dumb examples, but that you have something visually to work with, right? So we have a daily bearish sequential SMT here. Then your stop loss should be at the high here of the sequential SMT, right? And then what you do, instead of doing it there, you can also put it like after this fair value gap got tapped, do it at this high, right? So basically after the first entry reaction. I mean, a really stupid example, but I get what you mean. You just look for an entry reaction, like a fair value gap order block, and you just put your stop loss at the high of that reaction. But that's more advanced than when you're really sure that that your setup is going to work. Just focus on putting your stop loss at the high or low of the lower time frame sequential SMT. That's what I do 90% of the time. Take profit should be at low hanging fruit. So low hanging fruit is the next low or next high. You should really take profit as quickly as possible. Of course, not if it's a 0.002 risk to reward, then you should not be trading the setup anyways. But let's say I'm taking it right here. First TP will always be here, right? Because there will most likely always be a reaction, and you can let it run later for like this draw. Like if you have traded today this NFP, these would have been like your two TPs. You can have this low but I don't have like 3 or 4 TPs. I just have 2. I have one low-hanging fruit, next low, next high, and then one obvious high time frame draw, right? So this is actually a good example. So as I said, add low-hanging fruit, next low, next high. Or if there is clean higher time frame draw, right? There's clean draw, okay, nice. We have like low resistance liquidity right here. Then you can use this low. Like you should not be targeting, from my experience, like crazy low, high time frame lows. It will never get taken out, like only like one in 30 days when we have FOMC or something. But you should really focus on taking profit at low-hanging fruit. And if there is close high time frame draw, you can do it further, but don't aim for greedy take profits. Okay, that's really important. So then what I do is, after the low-hanging fruit is taken out, I take 50% off at least. So if I'm in 4 contracts, I take 2 out. If I'm in 5 contracts, I take most of them out. So 3 contracts, I'll take them out. If you go lower, we take out this. Stop loss will be right here. And then we go lower, do here, here, here. Not really any rules, but I just make sure that that price doesn't like do like this and go to break even. So I just really secure my profits and have my stop loss really close after low-hanging fruit is taken out, so that if there's a really big move and price displays like crazy, then I'm still catching some of that. So then trade management. After you're in a trade, you should continue to monitor the cracks and context, because this is how my system works, right? This is how this works. You should monitor for context and cracks, and with the biggest context and cracks, you form a setup, you form a bias, right? So after you are in a trade, let's say we have another SMT, we have another context, something else happens that's relevant to the system, then you should notice that and take action, take decisions accordingly, take profit or take an opposing entry, whatever, right? So you should always continue to monitor the cracks and context. So what I mean with this, more detail, you should close the position if the opposing cracks and context wins or when a retracement is likely to happen. So this makes sense. I just explained. If we have a daily and a 90-minute sequential SMT, we go lower. That's my setup. But then we have a weekly and a 1 hour, 4 hour PSP, and we have a lot of context and time and price and true opens. Then I should look for longs, right? I should take profit and look for longs, if everything makes sense. Or this is something really, really important, when a retracement is likely to happen. Usually, when you trade market maker models, you will not see price going straight to the drawn liquidity. Yes, that can happen on NFP, on FOMC, on these big red follower news events, but usually you see a smart money reversal, the first move inside the market maker model range, some chop, some consolidation, another manipulation, and then a displacement to the final draw. Or even this happens 2 times. We have 2 consolidations inside the market maker model. That's what an ideal market maker model should look like, right? But that's what I mean. After you see the first clean liquidity of the market maker model getting taken out, then you should just look for a partial, because then we can easily have a retrace, and then you will get stopped at a break even, and then price will go immediately towards the draw. So that's why it's really important to just take profits, and then later on you can always re-enter after more context with confirmation if the whole low-hanging fruit is still intact. So low-hanging fruit here usually is the next low or next high, but you can also see low-hanging fruit as like the market maker sell model low or the market maker buy model high. All depends on the setup, on how things are looking. Then risk management is just personal to me, but right now I want to use 1/16 of my drawdown on Funnets and then 1/8 of my drawdown on eval. So let's say I have a 4.5k drawdown on my challenge, then I will be risking $500 per trade, which means that I need to lose 8 times to blow my account or 16 times to blow my Funnet account. I will stop trading after 2 wins. This is the hardest things, I'm not gonna lie. I'm a fan of just trading whenever everything makes sense, and if that means I take 3 trades and 4 trades, so be it. But generally, it's best to just stop trading after 2 wins, and after a loss also I get 1 more try. That's just the best way to avoid spiraling into degenerate trader habits. But yeah, that's the ideal scenario. I'm gonna be honest, sometimes I don't follow these rules just because there's another clean setup, but this is what you ideally should do. Then additional notes. This is also really, really important. Showing up from 9:15 EST to trade the index futures triad. I'm only checking PM when news. So this is what I'm trading. I'm trading from 9:15 EST to 11, usually 12. That's the New York AM session. I'm trading the New York PM session. This is New York PM. Whenever there's FOMC, like usually at 2 p.m. EST, right? So that's when I'm trading. We all know that this is the best time to trade. It's when New York opens, a lot of volatility. A lot of volatility means that we have a lot of cracks that can be formed, a lot of structure that can be formed, a lot of big moves that I can capitalize on. Then, really important, the SSMT is not confirmed unless there is a synced time frame displacement. But it can be tradable if there are lower time frame sequential SMTs who have synced time frame displacement. See confirmation section. What does this mean? You will say like, what the fuck does this mean, Rui? I'll explain. So if I'm having a setup, I look for confirmation, displacement. I have FEG on the SMT timeframe sync, right? So this refers back to this. If we have a daily sequential SMT, for example, this one is not confirmed unless there is a 50-minute time frame displacement. If you wait for all these displacements to confirm these, then you're usually too late. So you want to actually catch potential sequential SMT sequences before every displacement happens on the corresponding time frame sync. Now, like I said, displacement for the entry confirmation, it needs to happen on the lower time frame sequential SMT. So let's say I'm having a weekly sequential SMT high time frame plus lower time frame daily sequential SMT setup. Then I just need a 50-minute time frame displacement, because then this can confirm this higher one. But this one doesn't have to have already an hour one displacement. It's nice, it would be really awesome if we already have this displacement, but it doesn't have to, okay? So this is what this means, like higher time frame one doesn't have to have a displacement, lower time frame ideally yes, or turtle soup, right? So that's what I mean with that. So again, the SMT is not confirmed unless there is a synced time frame displacement, but it can be tradable if there are low time frame SMTs who have synced time frame displacement. So just so you know when I see an SMT as confirmed or not. When you have, for example, this setup, we don't have a lower time frame, we just have an SMT in a gap. This is one of the combinations I use, SMT in a gap. Then yeah, I would need an synced time frame displacement. Let's say this is a 90-minute sequential SMT in a gap. I need a 5-minute displacement to trade this. Here, also, if this is a daily sequential SMT, I need a 50-minute. If this is a weekly sequential SMT, I need a 1 hour, right? So yeah, here I just explained, if this is a weekly plus daily, then I need a 50-minute displacement. I don't need an hour one. It's nice if this already has an hour one, but you don't need it because this in a way already activates this one, right? It shows that, okay, this one will most likely hold because we have an additional lower time frame sequential SMT. So yes. Next, I step away when emotions run high, market conditions are poor, or my concentration fades. Makes sense, right? Whenever I'm just not focused, I'm going to take dumb decisions. That's going to be a continuous loop of bad habits. So only trade when I'm really concentrated because I need to monitor both sides of the market constantly, right? Remember this, continue to monitor the cracks and context. Then I can trade against the biggest confirmed cracks if there is enough context and cracks. What does this mean? Like I know I said that you need to focus on trading in the direction of the biggest confirmed cracks. This is ideal. Whenever we have a monthly at the bottom, we look for bullishness. If a monthly at the top, like I explained in the previous example, right? You monitor both sides, whichever one has the biggest confirmed cracks. Again, confirmed means have a synced time frame displacement. If there's a monthly, you need an hour for displacement, creating an inverse value gap. That's when I see something as confirmed, right? But I can also trade against this direction if it makes sense. If we have a nice setup, for example, if we just need to rebalance to equilibrium, right? We can be bullish with the cracks with a monthly bullish sequential SMT. But if I see, oh, we are really, really high, we are prone to have a rebalance to a gap, we are just overextended. If it makes sense according to my system, if we have price sweeping above true opens, we have an SMT plus PSP, we have a high time frame sequential SMT plus a lower time frame sequential SMT. You can trade this if it looks clean, if it's a nice market maker model, if everything just makes sense. It doesn't matter that you trade just against this biggest cracks. That's what I'm trying to say, right? It just needs to look clean. Why does this look so ugly like this? Okay. And this brings me to actually the next thing. My system is not systematic, right? There's a lot of discretion. Discretion basically means I take my experience. I'm trading literally every single session for at least a year now. And that experience is like indirectly in my head. Subconsciously, I take decisions based on my experience, based on what I've seen. And yeah, mostly that's according to my system. But you have to understand that I'm not a mechanical trader. Like, to give you guys an example, if we have a higher time frame sequential SMT plus a lower time frame sequential SMT, like this, ideally you should have then this lower time frame at least confirming itself. So if this is a micro sequential SMT, you need a 30-second displacement. But there's times where, for example, do not wait for that, because everything else already makes so much sense and I do not need to wait more. Because, for example, there's so clean confluence there. We are sweeping below the true opens right at this point. We are in a gap, tapping 3 new day opening gaps. We have so clean low resistance liquidity right here. We have clean target right here. It's the best time of the day to trade. Then I don't really I'm a mechanical trader. That's what I'm trying to say. If everything looks clean, I'm just taking a trade. And this whole system is not mechanical. It's just how I trade, if that makes sense. It's not a mechanical system. I do not believe in mechanical trading. It can work, but I just do not like to trade that way. I just like to trade when everything makes sense, if that makes sense. So again, rule of thumb is basically, if it's dumb clear and you have conviction in the setup, you take the trade, right? And according to how much conviction you have, you can risk more or risk less, whatever. Then hidden sequential SMT is higher probable. Always look for this if you don't see normal sequential SMT. Again, we have 2 types of sequential SMT. The normal one, where we look at the highest high, lowest low of the previous quarter. If you take that out on the current quarter and not on the current quarter of another asset, then that's a normal sequential SMT. But actually this hidden, which looks at the closes, is higher probable, right? The closes SMT is actually how I believe and how they also believes the market works. We look at the closes, and whenever we have SMT there, it's actually higher probable than this normal sequential SMT. So that's just something I want to point out. It's actually higher probable, even though it doesn't look like it. So always look for this if you don't see the normal sequential SMT. Then the Dow is just an indicator. I do not trade it. If there are enough cracks on NQ and ES, I do not need the Dow. So, for example, if we already see the things that we need between ES and NQ, you see a lot of the times I just post 2 charts. Why is that? Because there's already enough information, right? You have to see these triads as something that constantly feed each other information. If we have a SMT and a PSP, SMT plus turtle soup of SMT, SMT plus low time from SMT, if you have all of these things with the context combined with them on NQ and ES, then you do not need YM. The only time you use YM on the futures market, the only time you use DXY on the Forex market, these 2 assets, DXY and YM, they're basically like third wheel assets. You don't trade them, but when you do not see something on NQ or ES, you do not see something on EU or GU, you can look for DXY or YM for more information, right? So you do not trade this, you just check for, oh, does this have an SSMT or a position swing point? Okay, I take that with me. So yeah, I hope that makes sense as well. And then also, the Dow is just an indicator. I do not trade it. If there are enough cracks on NQ and ES, I would actually say cracks and context on ES. I do not need the Dow. Then, again, taking this even further, If there are no cracks on all pairs of the triad, look for intermarket cracks on FXT and IRT. So you do not need this, and I don't really recommend it. I don't really use it. This is only if you do not see something on NQ and ES, you do not see something on NQ, ES, and YM, then you can look at the Forex market to feed some information into the futures market. These markets, it's like a wheel. They all feed each other information. For example, these three assets, they both move up. They do exactly the same thing one specific day. Then you can look for the Forex market, compare EU with NQ, and you check there for cracks, for sequential SMT, for PSP, for SMT fill, right? So yeah, that's next level. I don't really use it because most likely on a good day, you have enough information with NQ, ES, and YM. But there is days where it can be really beneficial if you do not see something within this triad. So this is inter-triad, this is inter-market. But yeah, do not focus too much on this right now. You don't really need it. So use higher time frame order flow to spot the clean turtle soup setups. I already explained this right here. And I will give an example like I said. But yeah, it will be obvious when you just need to wait for some displacement or when it's like a clean turtle soup. Yeah. Then there's just something else. Don't really focus on this. But there's even another SMT which is between months, and you check that on the daily time frame with a daily 1 PSP. Yeah. Like for example, I think even this month, the reason why we moved up here, this was doubling SMT because this is the low of December. This is the low of January. We take that out on NQ, but we do not take that out on ES. So that's, for example, a reason why we moved up right here into this higher time frame for Valley Gap. But yeah, that's just some another sequential SMT, but do not focus on this. They also said this in one of his lectures where you can look for this as well. And then lastly, every concept of my system is fractal and based on AMD. Literally everything. On market maker model, we have models inside models. Everything is fractal. Quarterly theory is fractal. We have cycles within cycles. Candles are fractal. And also everything moves based on AMD. AMD moves the market. Every concept in my system is basically AMD, like a candle, open, high, low, close. Market maker model, we have always a accumulation, manipulation, distribution. This is just something you need to understand. How does the market move? Every single day you need to realize what you need to look for is basically accumulation, which usually generates liquidity, a manipulation, which then generates the cracks, the PSPs, the SMTs, sequential SMTs, and the distribution, right? You can enter at the manipulation or distribution. This is just how the markets move. Every single day we move based on AMD. Trading hours, I think I already said this right here. Yep, only checking PM when news. Then lastly, there is an SSMT, just focus on this right now, an SSMT PSP synchronization as well. So we know that to watch a specific sequential SMT, you need to do this on a specific time frame. So for a weekly sequential SMT, you check this on an hour one time frame, right? Then you can easily spot the previous day low, compare it with the current day's low, and you can also really validate the hidden bullish sequential SMTs. Now, ideally, the PSP plus SMT combination, SMT plus PSP, where is the example? Right here. Ideally, you want this PSP also to be on the time frame where you check for the specific cycle sequential SMT. So let's say this is a weekly sequential SMT. Where do you check this? On the hour one time frame, right? Remember? Then you also want an hour one precision swing point. This is ideal. Whenever you see a weekly cycle sequential SMT, you have an hour one precision swing point, or you have a daily sequential SMT, 50-minute precision swing point. We have a 90-minute sequential SMT. You check that on the 5-minute time frame. Then you also want a 5-minute precision swing point. Now you do not need this. This is just for the best high probability setups, but it's ideal, right? You can also have a daily sequential SMT with a 5-minute PSP. Can also be a setup, right? But I just put it here because it's just the best synchronization with your PSP So just remember the time frame where you check to validate the specific cycle sequential SMT here should also be the time frame where you spot the PSP, right? And then even, like I said, taking things to the next level, key levels make the setup higher probable. There's also a sync with a key level, with a SMT, with a PSP, and even with an entry time frame. So let's say we have a weekly key level. So a weekly bullish order block, a weekly bullish fair value gap. And we are bullish because we have a monthly sequential SMT. And then we have an hour 4 position swing point. And then you can enter on an hour 1 fair value gap, for example. So this is just something you need to keep in mind. This is ideally how quarterly theory works. You have a specific key level paired with a specific cycle sequential SMT, paired with then a PSP, and then the best ideal entry time frame. So yeah, examples here. This is a daily cycle. So this is Asia, London, New York AM, New York PM. We have sequential SMT, so between 2 quarters of a daily cycle. This means this is a daily cycle sequential SMT. Now, we check this on the 50-minute time frame, like I explained there. Then you also need a 50-minute PSP, okay? 50-minute PSP present. Now, I didn't really draw this out, but let's say this is in a hour 4 fair value gap, then this would be the ideal thing. So this is an hour 4 fair value gap as well. Then you can take an entry on the 5-minute fair value gap, for example, here if it retraces. So that's just ideal scenario. You do not need this, but it's just if you really want to be specific and only want to take a few trades a week or something, or a month. But you will see this multiple times a week for sure. Then the microcycles is just a little cheat sheet that I use because remember, for hidden sequential SMT, you need to look for the lowest close and the highest close. If we have the microcycles, this actually goes on to the 30-second time frame. So for example, if we are between these 2 quarters, everything bullet right here was actually the best time to trade. But if we are, for example, between these 2 quarters, then I make sure the lowest close, it can be like at 10:52:30. So yeah, it's just a cheat sheet. Then I have some affirmations. These are mainly from Justin Werlein. The best ones that work for me are: I focus on the quality of my decisions by following my trading system and basing my decisions only on that. I am fully arriving in the process and accept what is. I build satisfaction from building good habits. I am an observer of the market and my emotions. I am patient and only trade dumb clear setups that follow my system like the market is calling me out. I see losses as a natural part of trading if I follow my plan, and I learn from avoidable mistakes. And then I journal like my life depends on it. So this is everything. I'm gonna put a link of this in the description. This is so much gems, so much sauce. If you understand this, maybe watch this 10 times over. Like, you will become so much better at reading price. Also, I have a version on the Figma. If this is gonna load. The same thing, but just not on a flowchart. I just thought it would be easier to explain like this with some lines, but this is a step-by-step as well. It's everything the same like here, but just in a more PDF standardized form. I recommend using this to learn a strategy, and then when you know how it works, you can use this. But let's just go quickly over this as well. So we repeat the system. So 4 reasons why markets move: hunt liquidity, rebalance to equilibrium, rebalance to inefficiencies, or generate liquidity. At least one of these reasons should be a confluence for a trade. Should be confident high time frame draw. There should be a confident lower time frame draw, which is the market maker sell model or buy model. Then you should monitor for inter-triad cracks, which are SMTs, PSPs, precision candles, precision gaps, SMT fills, and SMT market structure shifts. You should do this on the monthly, weekly, daily, 90, and micro cycles, and focus on trading in the direction of the biggest confirmed cracks. Now I have put a star right here, which refers to this. Again, the SMT is not confirmed unless there is a sync time from displacement, but it can be tradable if there are low time frame SMTs who have sync time from displacement, like I explained earlier. Now key levels, they make setup higher probable. So for early gaps, no opening gaps, just order blocks, don't really use them, but You get the point, right? Key levels in premium and discount. Then the smart money reversal is below the true session open and preferably the true day open as well if you're looking at longs. And the smart money reversal is above the true session open and did not change it right here. Not needed, but for higher probability, yes. Then next, time and price aligns, which means time in relation to the model. So the structure needs to look clean, clean AMD, taking out the high or low, clean generated liquidity. The structure in general of the market maker model just looks clean and ready to make the move. We have had the accumulation grind up, generating liquidity. We have had the manipulation, taking out the high. We have a displacement. The structure is ready. This is what I mean with the time in relation to the market maker model is ready. Now, and it needs to be around one of these clock times, red follow news event, New York open, macro windows. Then the confirmation, displacement on the SSMT timeframe sync timeframe of the lower timeframe sequential SMT, creating an inverse fair value gap or clean turtle soup. SMT market structure shift, a precision gap SMT fill can make the setup higher probable. Then, just something I added right here which really helps, the setup needs to look dumb clear. If it's not dumb clear, don't take it. Then entry, market enter, fair value gap limits, after first entry reaction or after more cracks and context with confirmation if the low hanging fruit is still intact. So confirmation, again, this refers to here, right? TP at low hanging fruit, next low or next high. But if there is close, clean, higher time frame draw, which is not too greedy, you can take 50% off at low hanging fruit and then trail aggressively with your stop loss after that low hanging fruit is taken out and then go towards that close, clean, higher time frame draw and just trail your stop loss with it so you do not get stopped out of break even and just don't waste any profits. So continue to monitor the cracks and context then. So this is trade management. Close the position if opposing cracks and context wins or when a retracement is likely to happen. Add to a position after more cracks and context with confirmation if low-hanging fruit is still intact. Then we have the additional notes, the same thing like on the whimsical right here. And then the risk and management as well. I'm not going to repeat this, my affirmations, and then these cheat sheets. Okay, one thing I want to add, maybe I forgot to say this right here, is that the context and cracks can balance each other out. So what I mean with this is I trade in the direction of the biggest context and the biggest cracks, right? So context is everything that has to do with reasons why markets move, the draw liquidity, true opens, time and price, confirmations, these things. And then these are the cracks, right? These are the cracks from this point. And so I trade in the direction of the biggest context and cracks, but let's say there are not many cracks, then if there is a lot of context, I can still take a trade. On the other hand, if there are a lot of cracks, but not a lot of context, then I can also still take a trade. So that's why I say that my system is not mechanical. I just need to take a trade when it looks dumb clear. This system just serves as how I look at the market. And then looking at this, I'm gonna add one more thing right here. And that is that I'm only checking pre-market or PM when news. Because I said I'm trading at 9:15. That's just usually how it goes. But there's also times when there's like pre-market 8:30 NFP or 8:30 and employment claims, 8:30 PPI. You usually have news like that, and I can still take a trade there. It's just preferably that I trade at the open, most volatility. But yeah, if there's crazy news at 8:30, like the biggest impact news, I can still trade around that time, just before the market open or 10 minutes after that news dropped or before, whatever. So I'm also gonna add this here. Okay, so now I'm gonna share with you guys this link of the system like this, and then also the PDF. I also want to share this, and I'll put it in the description of the video. Okay, let's get to the charts with some examples, because theory is nice, but actually trading this every single day It's very, very hard, of course, if you just learn about this system. So it takes time to really understand this, but I hope to give you guys some direction of how I implement this in the day-to-day trading. Now, I'm just going to give 1, 2, 3, 4, 6, 7 examples here. It's not a lot, of course, but I make weekly reflections, etc. So every single week you'll see a video of me going over the charts, going over the trades, and that's just literally using this system. So I just want to make this video of my whole trading system so that everyone knows what the hell I'm actually trading, so no one is actually lost. So my setup to trade looks like this. So I only use these 1, 2, 3 first 3 tabs. This is the futures market. So the first tab, I have the higher time frame. So I only look the 4 hour, 1 hour, maybe go to daily or weekly. You see here, you can save layouts as a view. You can see this is the IFT monthly to weekly layout. So then on the next view, I have like the lower time frame cycles. So why I do this is because you can do this on like one view, but when I toggle on all the cycles of this indicator, it just looks ugly and some quarters are missing. I just prefer to only have like 3 cycles, so it looks clean like this. We have this being the daily, the 90 micro. If you go lower to the 1 minute time frame, you see it's just really nice, and you see the fractability of quarterly theory. If this is gonna load, sometimes you need to like double click and double click again, then it will load like this. So this is the micro, this is the 90 minute, and this is daily, and then here you have the weekly and the monthly. So yeah, that's why I do this, to make everything look clean. If I look at the higher time frame, look at this. If I look at the lower time frame, I look at this. So this is for the monthly and weekly, and then this view is for the 50 minute, 5 minute, and 1 minute. As you can see, this indicator is called quarterly theory. On this view, only these 3 are selected, and on this view, we have only these higher time frame cycles selected. So as you can see, I also have the Forex triad right here. Same principle, higher time frame here, lower time frame here. And then I also always have like one chart that's just only one chart on my screen. If I'm taking a trade and I need to look at bigger view, that's the same thing here on Euro USD, because this is the biggest asset. On futures, it's NQ. And then I also have the interest rate triad right here, and also the crypto market right here. So I don't use like Forex market and the interest rates and crypto if this is looking clean. But when there is nothing on ES and Q and the Dow, I do look at the Forex market especially, and sometimes at the interest rates market. So if you want to check all the layouts, let me see, I think you can see all of them here. Yeah, so you can take a screenshot from this. These are all the views basically. I really like to do it this way, makes it really organized. So let's go to the first trade. So I picked some with different combinations of my model, some that are really obvious so that you can see how this works, and some that are a little bit hard, showing some different concepts of my system. I really recommend, if you trade futures, to not trade this chart. Just click on this, don't do this NQ exclamation mark. Just go for the specific chart, and this is now March 2025. If you're watching this later, it can be June or September or December, or maybe even 1 year later. But pick the specific chart of the year. Each year has 4 contracts. The ending month of the contract is the month that's displayed right here. So just do that. But for backtesting purposes, if I go to like December or last year June, then it will be ugly because it's not the right contract. So for now, I'm just gonna use NQ exclamation mark, ES exclamation mark, and YM right here. So some shortcuts, just double click if you don't want to see the quarters and just see the clean chart. You can also double click on one quarter and do the settings right here. Let's go to the first example. Funny enough, literally like 1 hour ago, 2 hours ago, it was NFP. And it's a perfect example of my system, a really clean trade that you could have taken. But I was recording this video, unfortunately. I should have done this way earlier in the day. But yeah, no be it. There's a lot of opportunity every single day, every single week. But this was today, I just checked the charts. It was actually really, really clean setup. So as you can see, always I draw out the true open. 7:30 is a true session open. I trade New York session. That's right here. And then the true day open is at midnight. So we have our true session opens right here. What happened today, we had NFP. This is NFP candle. I like this indicator to check for news. Right here, this is NFP, unemployment claims. What happened is in pre-market, 8:30, this is where the market opens, but because we had NFP, we had already the move in the pre-market. What happened is we had a smart money reversal above the true opens. So that's already a context following my system, right? But what else do we have? So we can go from top to bottom. So let's first start, toggle on the quarters right here. Let's first start with the monthly and weekly cycles. First, previous week. If we are referring to the monthly cycle, we look at the current week and compare it to the previous week. Okay, so the quarter here is not displayed, but you have to imagine this as the previous week. This is the low of previous week, this is low of previous week, this is low of previous week. We all take it out, so nothing happened right here. This is the high of previous week. This is the high of previous week, this is high of previous week, all got taken out. Now, nothing to see here, so we go lower, right? 1 hour time frame, which is where we check the weekly cycle, sequential SMT. What do we see here? If you mark out previous day's high, which you will always do when you check the weekly cycle for SMT, you see that we actually have weekly sequential SMT because we take out the previous day's high on NQ. We also do this on ES, but on the YM, we do not do that. Look at this. So this is a weekly cycle sequential SMT. And on the higher time frame, we're really, really bearish. We even have a monthly here at the top. So my bias was bearish today. Now, what else do you need? We have now price going above true opens. That's context. We have price also going to discount of the range. Not really clean range because yesterday was a bank holiday, but it made sense, right? We are now in premium of the range. We form SMT above the true opens. What else do we need? Time and price aligns. Yes, because it's at news. We have NFP and the structure also looks clean. Do we have nice draw? Yes, we have a clean target right here. On the lower time frame, did we have a clean target? Yes, we have this low, this low, this low, this low, this low. This was really nice lowest liquidity. I would say then this is my low hanging fruit if you take an entry, and then this is the higher time frame draw, right? So these then would have been your targets. Why is this not snapping? Like this, okay? Some ugly drawings, but you get the point, right? There is lower time frame draw and there is higher time frame draw. We have a manipulation. This created weekly SSMT, but then what else do you need? Like there is not really a combination of this, but yes, there is, because if you look closely, if you check the weekly cycle for sequential SMT, then you need a 1 hour precision swing point to form a setup. And look at this. This candle right here is a 1 hour PSP. Why? Because it's a swing high and it's down close on NQ and it's up close on ES and even up close on YM as well. So we have a weekly plus 1 hour PSP setup. This is literally all you need. This is a crazy good setup. A weekly sequential SMT plus a 1 hour PSP above the true opens, tapping around premium of the range. Higher time frame order flow is bearish. We have a draw on liquidity. We have a higher time frame draw on liquidity. Everything is there you need. And it's even aligning with time and price, because at this point right here, everything just looks right. We swept liquidity. This is the draw on liquidity. The structure did everything that is needed to go down, and it's around NFP. So what do you need? Like a 1 hour displacement then. So after this displacement, it was already really far away, but you can still then enter here and exit right here. Or you can then wait for displacement so that the SMT is confirmed and then go on the lower time frame like this, and then enter off of the fair value gap and then target the low. This could have been a trade, or you could have traded a turtle soup confirmation. After we turtle soup this high, created weekly bearish sequential SMT, confirm the 1 hour PSP, then you can just enter. That's a turtle soup entry for my system. So yeah, that is an example of today. How does this follow my system? 4 reasons why markets move. Yes, we generate liquidity. That's already one thing, so it's already good. High time frame draw, yes. Market maker draw, yes. We have clean low resistance liquidity. Check. We have a setup, SMT plus PSB. Okay, it's above 2 session open and through the open. Check. It's around one of these key times. Yes, we had NFP. Nice time to trade. The structure also looks ready. We're ready to go down. I'm going to be honest, this structure doesn't look perfect, but we took out a lot of draw. We displaced in the range. This looks like the market maker sell model looks ready to go down. Then confirmation happened, turtle soup, or you wait for the 1 hour displacement. The setup looks them clear. Okay, entry, stop loss should be at the high, TP there. And so your trade management would have been like this. After we take out the first low-hanging fruit. So low-hanging fruit can be this, but in this case it's low resistance liquidity, so you can take this as low-hanging fruit, and then after this got taken out, put your stop really close, trade it, and then maybe run it all the way towards this low. And here is when you really just take it out, because you don't want to target anything lower. I'm not sure if there's any clean draw. Maybe you can go here, but it's just really greedy. If you have one contract left, you can of course just ride it to there with your close stop loss. Literally just an example today while I'm recording this video. So yeah, really nice. And let's go to the other examples. So you would use the specific chart, right? I'm just using the NQ chart because I'm backtesting, and then I can go way back in time without price action looking absolutely terrible. So what setup did we have right here? Let me take a look. We have a higher time frame SSMT, which is a weekly and a monthly. So let's go over on how you spot this. Monthly, you spot this on the 4-hour time frame. So let's see how that looked like. Toggle on this indicator. And then go back to here. You can see that the high of the previous week was here, high of the current week was here, and we took it out on ES, and we did not do that on NQ. That's a monthly cycle SMT. Then the weekly, these are the most high probable ones, because in the monthly we also have a weekly, because if you think about this, a monthly is between 2 weeks, but a monthly can be also a weekly at the same time if it's between Friday and Monday. Friday and Monday, Q4 and Q1 is also sequential SMT. It doesn't have to be Thursday, Friday, and then stops. No, it can be between 2 weeks and still a weekly sequential SMT. And a monthly at the same time, right? Between 1 week and the other week, but also between Friday and Monday, between the days, a weekly sequential SMT. So actually, to make it simple, I am just gonna keep this as monthly. And then the weekly you can see right here. This is the high of Friday. This is the high of Monday. So we mark this as a weekly sequential SMT. High of Friday, high of Monday, weekly sequential SMT. Because we take it out on ES, we do not do that on YM. So because we had a monthly bearish and a weekly bearish cycle sequential SMT, I was bearish, right? This is how I form my bias. I check for the cracks in each direction. I see which ones are the biggest, which context is the biggest, and I trade setups based on that, right? We even had the daily. Daily, remember, we checked that on the 15-minute time frame. Let's go to here. So clean. Look at this. So I'm just gonna toggle on the daily cycle. Just refresh this. Maybe gonna just do it like this. Yes. So this is a daily cycle. Asia, London, New York AM, New York PM. This was the high of London. We take it out on ES. This is the high of London. We take it not out on NQ. So we have monthly, weekly, daily. This is when you just it's obvious that we are going for the lows. And we have clean liquidity on the lows. We don't have any clean liquidity on the highs. We are looking at lows here. This is clean liquidity right here that we can target. So with this bias, let me take a look what the setup was. A clean market maker sell model using this bias. So we retrace back to equilibrium of the range, we tap the gap, we swap buy side, which is one of the reasons why markets move. We have clean low resistance liquidity. What do we have else? let me check. We have now another SMT on a lower time frame cycle, which is on the 5 minutes. So just gonna toggle this on. If you check here, this is the 90-minute cycle. This is basically London session, 0 to 6 a.m. EST. We take out this high on NQ between the two quarters. We do not do that here. You see, that's a 90 minutes sequential SMT because this happens between quarters of the 90-minute cycle. And even the perfect PSP that pairs with this is a 5-minute PSP. And we have that right here. You see, this is a up-close candle on NQ. This is an up-close candle on ES, but this is a down-close candle on YM. So there can be a setup. So taking all this information with you, you can know that this is going to be the draw on liquidity, right? Then we have a displacement. Okay, this 90 minutes is confirmed. All of these SMTs are also confirmed, so you can just already take trades. But here is just a really clean entry, a fair value gap entry. And then put your TP here. This happens above true session open as well. So if you go over this whole system, everything basically checks out. We actually only need like 2 SMTs or 2 cracks, like a PSP or SMT or SMT and low time frame SMT. But here we have like multiple where you can form your bias. But actually just this was enough if we have a bearish context. This is a really nice market maker sell model. So this is another really clean example. Let me break it down. This is a combination that we can have, right? SMT plus PSP. We are bearish on the higher time frame. We have some higher time frame cracks right here. The narrative is just mainly bearish. So we form a 90-minute sequential SMT. Why? I don't know which cycle this is. 90 minutes, perfect. So this is the high of the previous 90-minute quarter. This is also the high of the previous 90-minute quarter. It is all not taking the previous high out. So why is this a 90-minute sequential SMT? Well, if you paid attention, this is not a normal sequential SMT, but this is a hidden sequential SMT, right? Remember, if this thing is going to load, this right here is what we are dealing with right now, a hidden. We look at the closes. If we don't see any sequential SMT, we look at the hidden sequential SMT. So why is this hidden? Well, if we go on the 5-minute time frame, which you should use if you are referring to the 90-minute cycle, then you see the highest close of the previous 90-minute quarter was right here. The highest close of the previous 90-minute quarter was right here on ES, and the highest close of the previous 90-minute quarter on YM was right here. And you see that it's really hard one, but this is actually a hidden bearish sequential SMT. We do not close a candle on the current quarter above here. We do not close a candle on the current quarter above here, but on YM, we actually, with this bullish candle, we closed above this highest close of the previous quarter. So that's the 90-minute sequential, hidden sequential bearish SMT. So that is an example I wanted to show you guys about hidden sequential SMT. And then even after this, what do we need? A PSP or another lower time frame SMT to form a setup. And we got that right here because this was the, let me just toggle on the microcycles then, now that we are at this. You can see that between Q1 and Q2 of this micro cycle, take out the high on ES, take out the high on NQ, do not take out the high on YM. So that's a 90 plus micro above the true session open. You will always see this. It's so clean. We always have these cracks and smart money reversals above the true session open if we're bearish, below if we are bullish. So literally cutting out so many errors. If you just focus on shorts when price is above true session open, and if you just focus on longs if price is below true session open. And on top of this, what else do we need? We need a clean drawn liquidity. Well, perfect. Low resistance liquidity right here. We have a low and a low. The highs don't really look that clean. And also, it doesn't matter if you form equal highs right here. The point is that we have what we need, and then you should not worry about anything else. So then, after a micro sequential SMT, you need a 30-second displacement. We are now on the 1 minute and don't really have access to 30 seconds, but 1 minute is the same thing. It's even higher time frame for more confirmation. So we create a 1 minute inversion, and then you can enter after we inverse this, right? Or you can even enter on the inversion even higher, But yeah, I just market enter right there. So there's some ways you could have entered this. To be safe, you put the stop at the lower time frame crack at the micro. So yeah, would have been here ideally. But you can also put your stop right here after we have that first entry reaction of this inverse, whatever, how much risk you want to put on and how much high probability you want it to be. But yeah, then you take your profit at low hanging fruit right here. And then in this case, we also had nice higher time frame trial liquidity, which is like this low. I really like to use like not the really low, but just like a clean low on the way there, because you usually see like price tapping first liquidity and then going up, retracing, you get stopped out, and then finally we go, right? So ideally here, but this is maybe too far away, too greedy, so you just take a low that's clean and that's in reach after taking out low hanging fruit, and it's not too greedy, if you get what I mean. So that's a really nice setup. High time frame SMT plus lower time frame SMT, tapping above true session open. This was around news. I don't know, this was NFP or unemployment claims. And then, yeah, a macro as well, which is a time element that I use in my system. So if it's inside a macro, it's also really good. So yeah, that was this trade. Let's go to the next one. This was a trade on ES. I think there was enough information between NQ and ES. So for now, I'm just going to leave the Dow. So this is ES on the left, NQ on the right. As you can see here, if I toggle on the weekly cycle, really clean. So this is the high of Wednesday. This is the high of Thursday. You see, if we just remove all the drawings, if you just look at the clean price action, we take it out on both assets. But this is hidden sequential SMT, because if you look at the highest close on the 1 hour time frame, which you should use to look at the weekly cycle, you can see that this is the highest close right here, and it's not getting closed above on Thursday on NQ, but it does get closed above here. So yes, I indicated like this, but it's actually like, I don't want to draw this ugly line, but it's a weekly hidden because you can see an hour one candle closed above the highest close of previous day, while here on NQ we do not. It's a weekly sequential SMT. A lot of people, they will say, but why did price move so hard down? Well, it's because of this. Literally, it's a correct correlation. They do something else and they should move in sync. If they do something else, then it's a correct correlation you can be used to frame a trade as well. So alongside this, what else did we have? Because just this is not enough. We have created this weekly sequential SMT, which is followed by a 5-minute precision candle. It's not really that the 5-minute precision candle is synced with this, but it's just nice to see, okay, we have another crack on the bearish side. And then here is where the clean setup formed. 1 minute time frame. Oh, you gotta be kidding me. I can't go back time. Yeah, this is annoying, but I think I have this in my playbook. So what is this? July 11th. Let me take a look. Yeah, right here. This was a setup. So this is the 1 minute time frame on ES. We have that weekly sequential SMT. We had a 5-minute PSP. And then this is where it really looked clean. Look at this. Generated liquidity. Lowest liquidity. Okay, we have a nice target. And then here is we have SMT fill. So we form a micro sequential SMT. So now we have two SMTs we can use, right? A weekly and a micro. That's a high time frame and a low time frame one. Now, ideally, you want a weekly and a daily, but this is also fine if you have enough context, enough draw, enough confluences like we have now, because we are tapping above true session open, true day open. We are going back to low time frame premium. We have nice stacked lowest liquidity. We have a nice target also on the lows. And this is at the key time of day, 10 a.m. Really nice to take trades. And so we have this micro. This is confirmed by a 30-second displacement. We got that right here. Could have entered already right here, but I entered here. And then, yeah, put your stop right here. The reason why this was a clean setup is because while forming this lower time frame SMT, we created an SSMT fill. Because I'm not sure, but I think it was this candle actually. We have this fair value gap getting tapped on ES, but not on NQ. So that's an SMT fill. So as you can see here, unfortunately can't go back to the 1 minute time frame for some reason. Stupid trading view. But if you can check here in this 5-minute candle, there was a 1 minute fair value gap right here, and it did not get tapped on NQ. You see it's lower, but on ES it did get tapped right there. So that's an SMT fill. Okay, let's go to the next one. I think on this example also we had enough cracks between ES and NQ. So I'm gonna focus on these two assets. What was the setup right here? We were bullish high time frame. We created a weekly and a daily. So 2 is already good enough. A 50-minute PSP. Doing this all below 2-day open, true session open. In an hour one fair value gap. In a new day opening gap. That's a setup right there. And this is an example of not a confirmation with a displacement and an inverse fair value gap, but an example of a clean turtle soup that I like to trade. Here, if you look at this is just a clean turtle soup, right? Why? Because we sweep it so cleanly below this low and we close a candle. I ideally want to see like a 50-minute candle or a 5-minute. It will also look clean. No, not that clean. So on the 50-minute time frame, it looked clean. That's all I need. This is a really indication that price just wants to stay up. And of course, this is not just a candle pattern, right? You need all of this other context and cracks that I'm going to show you right now. These, you need that, of course, and all the other context. So why was this a weekly and daily sequential SMT? Well, let's toggle on the weekly and the daily cycle. Weekly, daily, like this. Okay, so weekly, this is the previous day, this is the current day. What happened? Remember, we checked the weekly on the 1 hour time frame. I think actually we need to use YM because there was no SMT between these. Let me take a look. Yeah, exactly. This is a really, really hard sequential SMT, but it's just so you can know how ugly this can actually look and still work if it's aligning with the narrative. So the lowest low of Monday is right here. Okay, we take it out on NQ on the next day. Lowest low on ES is right here. Also take it out, so nothing happening right here. But on YM, this is the lowest low actually. We open the day right here, it's lowest low. And we do not, look at this, we do not take this out. Like, just not. And this is a weekly sequential SMT that we can take with us. So a really ugly one, but you see it still works. And then what else do we have? A daily, so we check that on the 50-minute time frame. You see here really cleanly, if this is just gonna load, please. Someone needs to make a new. If I replay it from here and have this daily cycle on, you see this low here is just when London opened, and we take that out on both assets, all 3 assets. But here, I think we are also dealing with a hidden sequential SMT. Because look at this. You see this? We both take out the low, but on the 15-minute time frame, we don't close a candle below the lowest close of London, but we do that on NQ. So that's a hidden daily bullish sequential SMT. So this is how I came up with the weekly and daily. There was nothing on the high, so nothing to worry about, but there was low resistance liquidity on the highs, clean liquidity, so nice high time frame draw. We have a 50-minute PSP, because if you look closely here, while creating this SMT, this is a down close candle on NQ, down close candle on ES, and up close candle, you see here, this is an up close candle on YM. So a daily sequential SMT plus a 50-minute precision swing point, that's a setup, right? Remember SMT plus precision swing point. We have all the narrative here. We are retracing back to discount of the range. We are tapping on hour one fair value gap. We're tapping new day opening gap. Look how cleanly we tap this. We create all of this context. We do this exactly smart money reversal below these true opens, true session open and true day open. We have clean low resistance liquidity. This happens at a key time of day, 9:30. That's when the market, CME market opens. So we have a lot of volatility. Nice time to trade. How was this entry confirmation? This was not a displacement because ideally then I wanted to have a 50-minute displacement. That would be somewhere right here, but then it would be maybe a little bit too late. This could have been a nice turtle soup entry like I discussed, right? So we have a clean turtle soup. You just market enter after you see the candle close really bullishly and then you target the highs. So that was this setup. I think also really, really clean. 2 sequential SMTs plus a precision swing point plus all of this other context plus the draw plus time is right plus market maker model looks clean as well, right? So yeah, that was this trade. Here, same thing. We had a weekly and a daily, but then now on the bearish side. So let us see how the weekly got put in place. We do that on the 1 hour time frame, even a monthly here. So let's start with the monthly 4 hour time frame. So let's toggle on the monthly cycle. Like this. You see that this is the high of the previous week. Take it out on NQ, but we do not take it out on ES. Monthly cycle Sequential SMT. Nice. What else do we have? A weekly. We checked it on the 1 hour time frame. Let me wait until this is popped up. Weekly. And you see why I have these different tabs, right? Normally, I'm just doing this because I'm backtesting, but normally you would only have certain cycles on different layouts so you can keep everything clean and don't need to toggle these on every other second. But yeah, the weekly was like this. This was Thursday and this was Friday. So Friday does not have a quarter, but it is included in quarterly theory. So you can have sequential SMT between Thursday and Friday, between Friday and Monday, just between days, right? So this is the high of Thursday on NQ. This is the high of Thursday on ES. We don't take it out on ES. We do take it out on NQ. So now we have two bearish sequential SMTs. I'm looking at shorts. I'm having a bearish narrative. Scale even more down. We have a daily and a 90 even there as well. So I'm gonna pinpoint this last one, but I think after this you get the point how you spot these sequential SMTs. But let me show you one more time for this daily and 90. So here, this is a daily quarter, this is a daily quarter, these are the 90-minute quarters. You can see that we take out the previous daily quarter on ES. We do also do that on NQ, but here you see we formed the high on the previous quarter actually, and we do not take it out on YM. That's a daily. And on the 5-minute, we check the 90-minute. That's the same thing. While we form that daily, we also form the 90. So that's really high probable. So here, 90-minute quarter, we take it out in this quarter. Here on ES, we do not take it out, right? You see here, SMT, so daily and 90. So we have a lot of bearish SMTs, monthly, weekly, daily, 90. Now you just need to wait for the right time, and usually that's around market open, macro times, news events, all of these times. I'm a scalper, so I then look for the best entry when the market opens at 9:30 EST, or sometimes pre-market, or in PM when there's just news and a reason to trade because there's volatility, and you get the point. So even, I was not even done yet, there was even a micro SMT as well, really sharp one, but yeah, same thing, right? I think it was with YM, yeah, this was the SMT then. You see here, take out highs of previous, but here we do not. So yeah, a lot of bearish SMT, that's the point, but because the lowest one is a micro, I'm just looking for a 30-second displacement. That's a sync, right? So I'll look for an inverse fair value gap. We create an inverse fair value gap right here. We have a displacement, not really displacement, but like we create an inverse fair value gap. We have all of this context, so you don't really need a really big displacement then, because the narrative is really, really bearish, because we are also doing this all above true session open and above the true day open, which is ideal for looking at shorts. We create a 1 hour and an hour for precision swing point, and this is in the 9:45 macro. So to see the hour 1 and hour 4 precision swing point, and these sync with the weekly and monthly cycle sequential SMT. So to see this, you can see here, this is an up close candle on Nasdaq on the 4 hour. This is a down close candle on ES on the 4 hour. And then the 1 hour, same thing here, up close on NQ, down close on ES. So it's just really a lot of context and cracks on the bearish side. So then when you enter right here, what do? You take your profit at the low hanging fruit, which is here, and then you let it run to high time frame DAR, which is a little bit lower here in the range. Yeah, so another nice setup. I usually like to target then like high time frame discount. I'm taking 6 RR, right? I'm not getting greedy and going towards this low, because that can usually happen like the next day or the next month. Don't be too greedy. I think this new day opening gap was a really nice target And also because it's then we are below 3-day open, so then we can potentially look for longs again if we have a setup and cracks. But I'm slowly losing my voice, so I'm gonna finish these last two. One last example I want to show you guys, and then I think this was enough for this video. So 6 December, stop the replay. Let's go to the daily time frame. This was right here. Okay. What did we have right here? When I mark out like this red dot, it means there was news. So here, a really nice example how news actually manipulated us, because we did not really have a lower time from sequential SMT, and it created actually an entry for us. This was 6 December, a month ago. Let me take a look what happened. Again, you will always see this is so clean. I don't think we need to DAO for this. We have enough to see on ES and NQ. Like, just backtest this. It always happens. Whenever we have an SMT, it's always below the true session open, true day open. Same thing if looking at shorts, always an SMT or a cracking correlation above these two lines. This is not a coincidence. This happens always. This is basically time-based discount, right? So while we have NFP dropping right here at 8:30 1 month ago, we created that 90-minute sequential SMT. And you might say, well, who would have traded this? Because this does not look like a SMT. Well, yes, it does, because this is a hidden sequential SMT again. So 5-minute time frame, let's toggle on the 90-minute quarters right here, 90 minutes. Okay, go back here. And it's not a hidden on ES and on Q because we don't close the candle below. So I think it was then with the DAO. It must be. Obviously, it was with the DAO. You can see here, the lowest close got taken out, 5-minute time frame, but not on these two assets. So that's 90-minute sequential SMT formed right when NFP dropped. So bam, and then you can know, okay, this bias is going to be bullish because at news, we created this below true session opens. And then here I was looking at longs at the 9:30 open because this happened at pre-market. So what happened here? Really nice setup that I want to show. This was a 5-minute SMT fill, which can even be another bias that we're going to go up, because here you see here this 5-minute gap, this here got tapped on NQ, but here it just stayed open. So a lot of people, they do the trade AS, they probably just put a limit right here, but they don't realize that NQ already filled this gap. So how I'm seeing this is, okay, NQ filled this gap, so ES does not need to fill it. That's an SMT fill. It can be used as a bullish bias again. So we build up a lot of bullish context and cracks. And then what we do here, let me toggle on the drawings again. We create low resistance liquidity. Again, this is how the markets move. We create low resistance liquidity. We take out liquidity, manipulate, go towards the trial, go to discount. This is just how the markets move every single day. And so here, 9:30, again, exactly at 9:30, we formed normal SMT. So again, I can still use normal SMTs, just not as high probable as if there would be like micro SMT, but still there's nothing on the bearish side, so I'm only looking at longs here. So we create this lowest liquidity, we manipulate this was nice liquidity, we manipulate this, take out, turtle soup this, inside this gap, immediately we have a 1-minute displacement. I just enter because everything just looks so damn clean. We also tap this 50-minute fair value gap while doing this, so yeah. That's just something I want to point out, and then just take out everything at this high. This was all-time highs. After this, you can expect price to just chop, which is probably what's happening right here. So yeah, you see not really any setup here. We just chop because the daily objective is just met, right? We just retrace, accumulate, and then wait for the next day for a next setup. So again, this is just an entry based off discretion. Like this just looks so clean. An ideal entry would be after this 90-minute sequential SMT. Now, I think this was an example of like SMT in a gap. I'm not sure if we had a gap right here. Yeah, right here. This was a gap. SMT in a small gap. So we create 90-minute sequential SMT. Inside this gap, we still respect the gap. We still respect discount of this range. What the hell is this tool? You know, what? Sorry. in discount of the range, 5-minute displacement. So I could have entered right here in the fair value gap after this 5-minute displacement, but I just chose to dig even deeper because I like the 1-minute time frame just for a nice stop rate and then entry after we displace. That's also something if you really want a precise entry. But this could also be a turtle soup entry. After you see this close, you can enter. So yeah, a lot of possible ways. It's not that I'm a mechanical trader. I just use my system as base of forming my bias and taking entries and just using this as my truth of source, basically. As my source of truth. Oh my God, I just need to end this video, man. Okay, I think this was this was everything. I know these were not the perfect examples, but every week from now on still I'm gonna post a weekly reflection. So I'm just using this system to trade and reflect on the week to become consistent in 2025. So every video from now on where I do trade recaps is all just using this system. So now I can just refer to the system if someone asks like, what even do you trade? Well, this is how I trade. This is my source of truth. It's what I use every single day. I just want to share it because I mean I hate gatekeeping. Why would you do it? I know still 99% of traders who watch this, they will see this and not implement it right. They will have a mental gap. They will not be ready for it. So they take stupid decisions. It takes time. I've been there, like I've blown so many accounts. I could have been profitable already like 1 year ago. It's because my mental was not good and all other decisions. If you pair this with psychology, you're gonna get profitable. If you're just using this and you don't have proper risk management, you don't have a good psychology, then of course you'll fail. Because I failed with the system because I did not have any psychology in check. I had bad habits. I was not following my rules. I was just finding myself take stupid trades that were not really following my system and just not being sized up enough on my A+ setups. So yeah, this is now my progress using this system for a little bit over a month now. So here I am on a challenge of the futures desk. This was December. So overall green, I am on, let me see actually, 2K in profit. To get my challenge, I need 3K more, but I'm really focusing on consistent results because I know when I am trading for the money, when I'm trading to get my payout, I'm not gonna get there. So I really want to get a slow grind this year and just really prove that my system is working, get more confident in it, and basically, just really focus on building good habits and not rushing anything, and especially journaling every single trade. That's the most important thing. At least like 500 to 1,000 words every single trading day, because this helps me the most. Every single day there are lessons you should reflect on every single day, because that's how I grew the most. On winning days, on tape reading days, on losing days, everything needs to be journaled, because this is how you grow. So if you got any value from this video, I would really appreciate a like or a comment on this video. I'm so glad to put this out here. 2025 will be for me to focus on building good habits and getting consistent, and I hope you will too. So let's rock this here, and I'll see you in the next video. Peace out.